Let's focus in again on Treasury yields. 467 is the 10-year this morning. We pulled back a little bit yesterday after the Treasury Department said it would increase the size of its government debt repurchases. For her insights on the bond market action and on the Fed minutes, let's bring in Kelsey Berro, fixed income portfolio manager at JPMorgan Asset Management. It's great to see you, Kelsey, again. What happens when announcements like this come down for you? Are you just how big of a deal is this?
So it was a surprise. So to take a step back, typically what happens when the Treasury wants to make a change, either to their issuance program or their buyback program, they're going to make that announcement at a quarterly refunding. We just had a quarterly refunding in August. We don't have another one until November. So no one was coming in and saying this is something that was on our bingo cards. Now, that being said, there has been a lot of talk over the last few weeks about what could possibly stabilize the long end of the yield curve.
Because everyone's watching the 30-year go to 533. Again, not that the 30-year is like the most important thing in the world, but it just tells you where, things are getting a little illiquid.
Right, exactly. And so I would say, so the way that these buybacks work is there's really two purposes that have been stated: cash management and liquidity support. This was under the guise of liquidity support, but really we weren't seeing a lot of liquidity issues within the bond market. We're seeing a material repricing higher in long end yield that's been happening, I would say, fairly gradually over a number of weeks and months, not necessarily liquidity concerns.
People just don't want to own it at these levels.
What this signals is that the Treasury is looking at the yield level. Right. That's obviously what is influencing that decision. So I think what we need to do is we need to think about what got us to these yield levels and what could the catalyst be to stabilize yields, and will this announcement from the Treasury be enough to stabilize yields? As it relates to what drove us here, I don't think that it should be lost on people that what really started this regime shift was the war in Iran. Right. It was the closure of the Strait. It changed the risks and the balance of risks around inflation. Now, even this morning, I've been looking at oil prices, and they're actually starting to climb higher again. So we're not out of the woods from that situation. The other thing that has changed over the summer is we got a new Fed chair. And this would be a difficult environment for anyone, even if we had continuity in leadership. But we haven't. We have a new Fed chair. The market is still understanding what his reaction function is, and that has also injected a lot of term premium into the market. Now, what do you
think there's term premium? So I'm surprised by.
So I would say yes for term premium, and there are a couple reasons why. When you look at the repricing, a few things really stand out to me. One, inflation expectations remain extremely well anchored. So this move higher really hasn't been, at least according to the bond market pricing, a fear around runaway inflation. The second thing is the pricing of the terminal rate. So how high the Fed funds rate is going to get in this cycle. That has actually stayed fairly stable. So if the market was really sending a signal that the economy was overheating, the Fed policy rate was in the completely wrong place, I would expect market pricing of the terminal rate to come up a lot. That's why when you eliminate those two things, you get to this term premium type of discussion that we're having. Now, how do you stabilize yields, right?
Well,
I heard you guys.
How would you, by the way, explain what to me? When I think of term premium, I think as people don't want to hold this stuff, as much as they. How would you explain it in sort of lay terms? I
mean, I think that's fair. What you're getting at, in essence, is the additional compensation that investors require to hold longer dated bonds. And it's that additional compensation. Why do you need that additional compensation? Well, there's a variety of factors. It could be the uncertainty around the geopolitical environment. It could be the uncertainty around the Fed framework. It could be the deficits, the corporate supply. Term premium can incorporate a lot of different things.
Some argue that it's because we have so much issuance of AI debt that people don't want to own long-term treasuries. I'm not sure that I buy that, but that may be the case. I don't know. In which case, this is a totally different discussion than anything that has to do with the deficit.
So one thing that is different, I would say, about this move higher in yields relative to last year around Liberation Day is that when these yields are moving higher, you're seeing incremental demand within the fixed income market. So people are looking at these higher yields and they are saying, actually, these are attractive. So the flows are continuing to be positive within fixed income. And that is something that is different from last year when you saw a lot of concerns around Sell America and, the dollar debasement trade. This is a bit of a different flavor, and it has to do with the fact that the underlying growth fundamentals of the U.S. economy have been very strong. We just got through an earnings season where people really couldn't poke holes in the results that we got from corporate America.
So when you look at this situation and what the administration announced yesterday, long term, do you think that this instills confidence? Because you say to yourself, we've got a great Treasury Secretary who is a trader with expertise, who's going to manage our bills better? Or do you say this is a administration, and I don't know if it's an administration, but you could take the politics out of it, but we are now in a situation where we are involved and engaged in financial engineering, and that not only is not going to instill confidence, that it is going to undermine confidence longer term?
So the Treasury has a set of tools in their toolkit. This is not a new tool. They've been doing buybacks since 2024. They've opened the door to do more, I think, in a way that can instill some near-term stability. But ultimately, these yields or lower yields can't be sustained unless it's supported by the fundamentals. And that's why you have to get back to what is the trend for growth, what is the trend for inflation, what is the framework for the Federal Reserve. That's what's going to ultimately drive yields. And if you look at October 2023 and that period of time where you had the move higher in yields, the Treasury stepped in. It wasn't just the Treasury. It was also the fact that the data came in softer, the Fed shifted their communication. It's never just one thing.
Yeah, you need a lollapalooza. Let me ask you before you go quickly, what is your theory or philosophy of Fed funds rates? I think it'd be nice for the Fed funds rate to move a little bit more, up and down. That this is a pipe dream. Maybe it's silly. But I ask because if there's fewer Fed meetings and the Fed funds rate is left where it is for longer periods of time, even just a couple weeks here and there, is that a big deal to you? Is that appropriate?
So I noticed that in the FOMC minutes, which also came out yesterday, but they really felt like a sideshow, to be fair. All of the price action came on the Treasury announcement. It didn't come on the FOMC meeting minutes. I would say the 8 meetings make sense to me. If you remove some of them, the current structure makes sense to me. If you remove some of them, the market's still going to want information between meetings. And instead, they'll listen to whoever will speak in between.
Kelsey.